Listen, I need you to hear me on this one. Sit down, turn off the noise, and pay attention, because what I am about to break down could be the most important positioning decision you make this entire year. I have been in institutional banking for over 40 years. I managed money through Black Monday, through the dot-com collapse, through 2008, through COVID. And I am telling you right now, the pattern that is forming in this market is one I have seen before. It is the pattern that emerges when wars wind down and capital starts looking for its next home. The question is not whether money is going to move. It already is. The question is whether you are going to be standing in its path or watching from the sidelines wondering what happened. Right now, the entire financial media complex is hypnotized by defense stocks. Lockheed Martin is up roughly 38% year to date. RTX, formerly known as Raytheon, has climbed over 60% in the past 12 months. Every headline screams missiles, drones, fighter jets. And listen, those companies earned that run. This Iran situation is real. The strikes on Tehran, the Strait of Hormuz disruptions, the scramble for munitions, all of it justified the move higher. But here is what they are not telling you on television. The smart money, the institutional capital that I spent 4 decades managing, is already looking past the conflict. They are reading the same signals I am reading. President Trump just told reporters this war is going to end soon. Markets surged on the comment. Defense names like Lockheed and Northrop Grumman actually pulled back on that news. And that pullback, that little tremor, is the first crack in the dam. Today, I am going to walk you through a professional blueprint. This is the kind of framework we used at JP Morgan when geopolitical cycles shifted. We called it the rotation playbook. When conflict premiums start to fade, capital does not sit in cash. It hunts for the next catalyst. And right now there are 3 specific sectors that historically explode when wars end and peace premiums get priced in. I'm going to show you exactly where the money is headed, give you the names, give you the fundamentals, and give you the honest risks. That is what we do here at Invest with Marcus. No hype, no pump, just the straight talk that built generational wealth for the families I served for decades. Before we go any further, subscribe to this channel and hit that notification bell. The insights I share here come from a lifetime of managing real money in real markets. You will not find this perspective anywhere else. Drop a comment below and tell me, are you positioned for the post-conflict rotation, or are you still chasing yesterday's trade? Now let me set the macro stage, because this is critical. We are sitting in March 2026 and the geopolitical landscape is shifting underneath our feet. The Iran conflict that began on February 28th sent shockwaves through every asset class. Brent crude surged from around $70 to over $110 per barrel within days. The Dow dropped 400 points on March the 2nd. Oil prices spiked, the dollar strengthened, gold ripped higher, and defense contractors went vertical. But then something happened. Markets started to recover almost immediately. The S&P 500 actually finished that Monday nearly flat after being down over 1% at the lows. The Nasdaq, the tech-heavy index, actually closed positive that day. Why? Because Wall Street has studied 85 years of geopolitical shocks, and the pattern is remarkably consistent. In the first month after a major event, the S&P 500 loses about 0.9% on average. But 6 months later, it is up 3.4%. The market shakes, then it recovers, and then it rotates. That rotation is where the real money gets made. And we are right at the beginning of it. Let me tell you something I learned managing dividend portfolios for high net worth clients. When a conflict winds down, 3 things happen almost simultaneously. First, the war premium that inflated defense stocks begins to deflate. Lockheed Martin is trading around $649 right now, with a PE ratio of about 30. Analysts have a consensus hold rating and a price target of roughly 576, which is actually below where it trades today. That tells you Wall Street sees limited upside from here, even with a $194 billion backlog. The stock ran on fear. When fear fades, the premium compresses. Second, energy prices stabilize and often decline, which acts like a tax cut for the entire economy. If oil drops from $110 back towards $70 or $80 on a ceasefire, that is a massive tailwind for consumer spending, corporate margins, and overall economic growth. Third, and this is the one most people miss, risk appetite returns. Investors who were hiding in defense and commodities start hunting for growth again. And when that capital comes flooding back into the market, it does not go everywhere equally. It targets specific sectors with the best combination of growth, innovation, and structural demand. So let me walk you through the 3 sectors that are positioned to capture this rotation. And I am going to give you specific names in each one, because that is what professionals do. We do not deal in vague themes. We deal in actionable intelligence. The first sector is big tech and AI infrastructure. Now I know what you are thinking. Marcus, tech has been struggling in early 2026, and you are right. The Magnificent Seven stocks have underperformed this year. Technology and communication services have lagged, while industrials, energy, and consumer defensives have led the market higher. But here is what my 40 years of pattern recognition tells me. That underperformance is creating the setup. When geopolitical fear fades and oil prices normalize, the first place institutional money flows is back into the secular growth leaders. And the secular growth story of this decade is artificial intelligence. The AI infrastructure build-out has not stopped. It has just been temporarily overshadowed by war headlines. Companies like Microsoft, Amazon, and Google are still spending tens of billions on data centers. The demand for compute power, for networking equipment, for cooling systems, for semiconductor design software, none of that went away because of Iran. It just got temporarily mispriced. Let me give you a specific name to watch: Arista Networks, ticker ANET. This is a $165 billion company that builds the high-speed networking gear inside AI data centers. Revenue growth over the past 2 years is up 115%. Free cash flow has grown 538% in just 2 years. Current year-over-year growth is running at 28%. They have 0 debt and $10 billion in cash. The forward PE is 39, which for a company with these fundamentals in this environment is very reasonable. Here is the key insight. You literally cannot build modern AI infrastructure without the networking solutions that Arista provides. Every data center expansion, every new AI cluster, every upgrade requires their equipment. When the war premium fades and capital rotates back into growth, companies like Arista are going to be first in line. Another name in this space is Vertiv Holdings, ticker VRT. They specialize in immersive cooling systems for data centers. Think about this. As compute demand explodes, you need more data centers that are denser and more efficient. Every single one of them needs Vertiv's cooling solutions. Revenue growth is up 80% over the past 2 years. Free cash flow is up 440% and still growing at 27% annually. The forward PE is only 34, and the total addressable market for data center cooling is expected to reach $70 to $90 billion per year by 2030. Vertiv currently generates about $9 billion annually. That is massive room for expansion. When I was at the major firms, we called companies like this picks and shovels plays. During a gold rush, you do not bet on which miner finds the biggest nugget. You invest in the companies selling the shovels. Vertiv and Arista are selling the shovels of the AI revolution. The second sector is cybersecurity. And let me tell you why this one is absolutely critical in the post-war environment. The Iran conflict has exposed something that every institutional investor already knows, but most retail investors completely ignore. Modern warfare is not just kinetic anymore, it is digital. Every military operation involves massive cyber components. And when the shooting stops, the cyber threats do not stop. They intensify. After every major conflict in the past decade, we have seen a surge in state-sponsored hacking, corporate espionage, and infrastructure attacks. Iran's cyber capabilities are well documented. Even after a ceasefire, the digital battleground remains active for years. That is structural demand for cybersecurity solutions, not cyclical. Let me give you a name. CrowdStrike, ticker CRWD. This company owns approximately 20% of the endpoint security market. Revenue growth over the past 3 years is up 124%. Current year-over-year growth is running at 22%. Free cash flow is up 95%. They operate on recurring subscription revenue, which is the kind of predictable cash flow that institutional investors love. Here is what makes CrowdStrike particularly compelling in this environment. As artificial intelligence becomes more prevalent, hackers are using AI to launch more sophisticated attacks. That means the attack surface is expanding. Companies are more exposed than ever. CrowdStrike's Falcon platform becomes not just valuable but absolutely essential. The total addressable market for cybersecurity is expected to hit $85 to $100 billion by 2030. CrowdStrike is currently generating about $6 billion annually. There is enormous room for growth. I also want to mention Palo Alto Networks, ticker PANW. Their Prisma AI security platform tripled its customer base in just 1 quarter. Total sales are projected to reach approximately $11.3 billion by 2026, representing nearly a 23% increase. And they just made a massive $25 billion acquisition of CyberArk to strengthen their identity and access management capabilities. In the post-conflict environment, governments and corporations alike are going to dramatically increase their cybersecurity budgets. This is not discretionary spending, this is survival spending, and the companies that dominate this space are going to see earnings accelerate as the war premium shifts from bullets to bytes. The third sector, and this is the one that most people are completely sleeping on, is infrastructure and industrial reconstruction. Every conflict in modern history has been followed by a massive infrastructure spending cycle. After the Gulf War, Korean construction companies won billions in Middle East reconstruction contracts. After Iraq, infrastructure spending surged globally. And the pattern is already forming right now. Foreign investors in South Korea have been aggressively buying construction stocks even while dumping $7.3 billion from the broader Kospi market. They are positioning for what comes next. The Iran conflict has disrupted approximately 20% of global oil supplies transiting the Strait of Hormuz. Qatari gas facilities were attacked. Energy infrastructure across the Gulf region has been damaged or threatened. When the ceasefire comes, and it will come, somebody has to rebuild all of that. Countries are going to pursue infrastructure diversification policies. Oil-producing nations are going to expand facility investments to protect against future supply chain disruptions. Large-scale energy project contracts are expected to increase, particularly in the Middle East and North America. But the infrastructure play is not just about rebuilding what was damaged. It is about building what the conflict proved was necessary. The United States has already committed to reshoring critical supply chains. The defense budget is heading toward $1.5 trillion by 2027, and companies in the industrial sector are already outperforming. Industrials have gained more than 16% so far in 2026. Caterpillar, ticker CAT, has been the largest contributor to that sector's performance. Its generators are now being used to power AI data centers, which gives it exposure to both the reconstruction theme and the AI build-out theme simultaneously. GE Vernova, the electric power company spun off from General Electric, is another name positioned at this intersection. It has historically held market-leading positions in gas power and is positioned for material margin expansion as energy transition businesses, including LNG, hydrogen, and carbon capture, increase construction demand. Now here is where I need to give you the straight talk that most channels will not give you. The anti-trap warning. I am seeing a lot of chatter online about people loading up on small-cap defense names expecting the war to last forever. Let me be very clear. Wars do not last forever, and defense stocks do not go up forever. Lockheed Martin is trading at 22 times trailing free cash flow right now, which is above its historical range of 14 to 18 times. Seeking Alpha analysts are calling it a textbook hold. The company's own guidance for 2026 is only about 5% revenue growth with CapEx rising sharply. Free cash flow guidance was actually reduced. When you see a stock trading above analyst price targets with slowing growth and rising capital expenditures, that is not a stock you chase. That is a stock you respect and then look for better opportunities. The same discipline applies to RTX. Yes, it has a $251 billion backlog. Yes, it just secured major contracts. But Morningstar says the stock is trading at a 135% premium to fair value. Analyst consensus price target is about $191, which represents nearly a 9% decline from current levels. And insiders have been filing to sell shares. When insiders sell and analysts see downside, that is the market telling you the easy money has been made. The institutional playbook is not to sell defense positions in a panic. It is to gradually reduce exposure as peace becomes more probable and redeploy that capital into the three sectors I just outlined. That is how you protect the gains you have already made while positioning for the next wave of wealth creation. Let me bring this all together for you. We are living through a pivotal moment. The Iran conflict is winding towards some form of resolution, whether that takes weeks or months. When it does, the biggest rotation of capital since the pandemic recovery is going to unfold. Defense premiums will compress. Energy prices will stabilize. Risk appetite will return. And the money is going to flow into AI, infrastructure, cybersecurity, and industrial reconstruction with the force of a river breaking through a dam. The families I served for 40 years at the major banks did not build generational wealth by chasing the last trade. They built it by positioning for the next one. That is what I am asking you to do right now. Study these sectors, research these names, understand the fundamentals, and when the rotation hits, be ready. This is not about getting rich overnight. This is about building something that lasts, something your children and their children can benefit from. That is the Marcus philosophy. That is what we build here at Invest with Marcus. Now I need to hear from you. Drop a comment below and tell me, which of these three sectors do you think has the most explosive potential once the conflict winds down? Is it AI infrastructure, cybersecurity, or industrial reconstruction? I read every single comment, and your perspectives help shape the content I bring to this community. If this breakdown gave you a perspective you were not getting anywhere else, do me a favor. Hit that subscribe button, turn on notifications, and share this video with someone in your life who needs to hear it. The next video I am releasing is going to go even deeper into specific entry points and technical setups for these rotation plays. You do not want to miss it. Until then, protect your capital, stay disciplined, and remember, generational wealth is not built on hype. It is built on knowledge, patience, and the courage to move before the crowd. I will see you in the next one.